This video is best viewed in higher definition. To enable, click the Settings button at the bottom of the page, just here. Then click the drop-down box under Quality, and then select the highest definition offered, in this case 720 HD. Enjoy the video. So I'm now going to look at the inputs for the 7th screen of DTFL Pro. 1, 2, 3, 4, 5, 6, 7, which is this one here, which is that's all part of the management of the trade and the closing of the trade. So it's the standard and Adr take profit exit. Lots of inputs here. It's split into two distinct different sets. One is a standard take profit target, which is here, which you can select on or off. The other is an take profit target based upon ADR. You can select both of them or either of them. You can have them both running simultaneously, or you can select, if you've got a preference, one or the other. So first of all, I'm going to deal with the standard take profit. So if you wish to select that, you just click this on, and that means you'll be selecting the standard take profit. The first thing is to set the take profit target, which is a simple pip amount that when your trade reaches that pips of profit, then the EA will take certain action. So let's look at on the chart. We've got, like, this is the Asian session in grey here. You've got a stop run here of the lower level. It's red. Let's assume this is a PP line. There's been a stop run. Then this big blue candle here is a confirming candle. It's confirmed up. Then it's immediately pulled back. And so there will be an entry taken somewhere in this area here, which is, let's see how far from it. If it pulled back to around, so that's about 12 pips from the high. So there'll be an entry taken. Let's say we put an entry in. Let's say there's an entry taken around this level here. So there'd be the stop run. Then there's a confirming candle here, confirming. Then there's a pullback, and let's say it was taking at this right here, which is about, as I say, what would it say, 14. Bear in mind our entry range tends to be around 15 pips. That's quite reasonable to say that the entry was taken at 14 pips. It may well have pulled back a little bit further, but we'll say it was at 14 pips. So what you're setting here is that as soon as, this is the entry price here, as soon as the 40 pip level have been reached, which is there, 40 pips of profit, then you're telling the EA when 40 pips of profit are reached, close this percentage of the trade. In this case, it's 100%. So very quickly here, this big candle here, you would have achieved the 40 pips of profit, and the trade would have, there's 40 pips of profit, just around here, just around this area here. The trade would have been 100% closed with 40 pips of profit. If you'd have had 50% there, then when it got to 40 pips of profit, 50% of the position would have been closed. So when it got to around here, 50% of the position would have been closed, and the remaining 50% would start to trail current price. So what would have happened? You would have set the trail distance, which is at 10 pips, and the trail step, which is at 2 pips. What that's saying is that, so the 40 pip level was here, 50% of the trade would be closed, and then 10 pips from current price, so around this area here, the stop loss would immediately be moved 10 pips from current price, and then as the current price moved northwards, the trailing stop would trail in 2 pip increments behind it. So as it was going up, if it was just going up and up and up and up like this, we'd be following at every 2 pips. We'd be initially be 10 pips behind, so it would be, there was 40 pips of profit where it was taken. The stop loss would be moved to 30 pips of profit, and then as every 2 pips that the current price moved northwards, so when it moved to 42 pips of profit, we'd move to 32, then it moved to 44, we moved to 34. When it moved to 46, we moved to 36. So as it went up and up and up, and in theory, if it was a perfect world, I'm sure it wouldn't have happened at the time, but it got up to, well, just over 100 pips of profit. If we were still trading, we'd be at 90 pips of profit. And then when it came back down here, it would hit that stop loss at around 90 pips of profit. So you'd have had 50% of the trade closed at 40 pips of profit, and then the other 50% closed out at around 90 pips of profit. In an ideal world, that's what would have happened, but I'm sure there's some retracements here. Stop loss, even though it was trading, probably would have been hit prior to that. But that's how that works. Quite simple, really. You can set your take profit target. You say how much of the position you want to be closed when that profit target is reached. The remainder will automatically trail. The stop loss will be moved to this distance away from the 40 pip level, so it moved to 30 pips of stop loss and we moved to 30, and then it will start to trail current price. If you put 5 in here, if you put 5 in here like that, then what would happen is that every 5 pips of profit it moved northwards, then it would step at 5 pips. You may ask, why would you want to have a larger number there? Well, what it allows it to do, it allows the current price to move further away from you. So at one point it's actually going to be up to 15 pips away from you, and so it's keeping the distance a little bit further less. So if it is a retracement, it's less chance of your trading stop being hit. So it's just a judgment call how you want to set that up. So I think that's quite easy to understand, the take profit target, how much you want to close when it reaches this level, when it hits that target, how much you want it to be closed. If it is 100%, obviously there's not going to be any trails, there's nothing left of that position to trail. And you can select any amount here. You can put, when it hits 40 pips of profit, close 10%, and you can trail at whichever initial distance you want. You could be 20 pips behind, 15 pips behind, 5 pips behind, and you can step at whatever pips you want as well. There's something else I should mention. It's very important that you put a set take profit target in this field, because even if you aren't using the standard take profit, even if you're not, don't intend to use it, and you only intend to use the ADR, which I'm going to describe in a moment, there are circumstances where the EO will automatically revert to the standard take profit target. So you need to have something in there, even if you're not selecting it. Before we go on to the ADR take profit target, which is all explained here, just deal with these two inputs. The DTFL ADR up here, this is recalculated every single day, and it's displayed here. If you want to turn it off, you just click in here, apply, and it will disappear. And you said yes, I do want to hide it. And if you don't want it hidden, then you untick it, apply again, and it will appear again. There it is. If you don't want to have it in the top green, you don't have to. The same figure will be displayed here. So if you want to know what the ADR is, you can always open this panel and have a look at it, and it will tell you it's 156.1. So when it's recalculated, it will display it up here. Like I said, it will display it in this box here as well. So you don't have to have it displayed up there if you don't want to. So I'll just mention that. But the DTFL ADR, what that is based upon and how it's calculated is from these two inputs here. So you need to select here the total amount of days upon which the DTFL ADR is calculated. When you put 14 in here, what you're saying to the EA is go back the last 14 days and look at the range, the daily range for the last 14 days, find the average and then display it here. So in this circumstance, you've got 14 here. So what it's going to do at a certain time of day, each day, it will calculate the ADR for the day. It will then go back for the same time period for the last 14 days, looking for the daily range each of those days, average it out, and that's the result it displays there. The next input here, which has got 22 in, is telling the EA when to calculate the daily range from. So the time or the number you want to put in here is the time that your broker starts their trading week. In this circumstance here, the trading week starts for this broker. It's a GMT broker. It actually starts at 2200, so it does Sunday trade. So it starts the trading weeks at 2200 on a Sunday, and so that's why I've got here 22 entered here, because that's the hour this broker and this chart starts the trading week. So what will actually happen here when it's calculating the DTFL ADR, it will look back 14 days to 2200 hours. It will start at 2200 hours, look to the next 24 hours ahead to the next 2200 hours, look for the high and low between that time, which gives you the range. Then it do it for the next day from 2200 hours to 2200, look for the high and low, which gives you a range. And it does that for 14 days, and then it will give you this calculation here, which will change automatically and redisplay every day here and down there. If you had a broker that had started the trading day at midnight, you put a 0 in there, and then when it's making its calculation, it will go from 0000 to 000 the next day, and then 000 to 000 the next day, and it will do that for 14 days, average it out in that way. Look at the high and low on each of those between those time periods, that gives you the range, and then look back 14 days to calculate it. So that's what this does there. That's how that's calculated. So hopefully that's all clear. Now we'll go on to how do you use the ADR take profit for setting your exits. So first of all, a little bit of information about the ADR. When we're working out the ADR, in this case it's 156.1. Let's assume that's what it is for this day. So this is the Asian session. In the circumstances I use this DTFL Pro, I'll be setting my PP lines around this time, just at the end of the Asian session, and I'll run them from the end of the Asian session or the start of the London session through my trading times, which usually the same as most of the rest of the year. There'll be a session during the London session, and then another session during the New York session. So I set them all up in advance. And so what would happen here, let's say I've got this lower line here is a PP line, and you've got the stop run, you've got then the confirming candle, you've got a pullback, and you've got an entry. Same as we had when we were talking about the standard take profit. Now when the entry is taken here, there is no, because I haven't selected it, there is no target as such, no standard target for the trade to be closed. However, what it's based upon is a calculation using the ADR. The benefit, what this is allowing for, is if you're always using the ADR, then it allows for the differences in the market. Back in the summer, the ADR was only maybe 50 pips. Now it's up at over 150 pips. So it allows you to set your target profits in comparison to what the market is doing in the last 14 days. So if it's been a very volatile market, which it has been of late, then it would tend to extend your target profit. And it's in the assumption that in the last 14 days it's been a fairly volatile market, you're expecting it to be a fairly volatile market today. That's the assumption you're making when you're deciding to use the ADR. If it's been a less volatile market, so the range is only, say, 60, 70 pips, then the ADR will be less, and therefore you're not expecting such a volatile market, and the take profit will be less. So that's the rationale between why you're going to be maybe considering using the ADR as well as the standard take profit target, or even on its own. But let me show you how it works. So first of all, you need to understand what the target range, so you can set it. When this trade has been taken, so we're going to assume there's an entry here on this red line here. This was the PP line, there was the stop run, confirming candle, and this was the pullback, and we're assuming there's an entry taken here. As soon as an entry is taken, what the EA will do, if it's looking at the, if you've selected this here, and it says using the ADR target range, it will set it, and it calculates it by taking the low of the day, which is this point here, and then it will apply the average daily range, which is 156.1 pips, and it will measure the distance from there, and that will give you a target price there. That's about 100. That line there is approximately 156.1 pips from the low of the day. So that gives you where the at this time when this trade is taken, if the range is going to be the same as the average of the last 14 days, we would expect price to move up to this level here. That's where we would expect it to move, if you accept that philosophy and believe in it. So what we're doing here is it takes that level and then we apply a range, which what I've put here is 40 pips. So on quite a volatile market like that, I'm using a higher figure here. 40 is quite reasonable. It's something you're going to have to find out yourself from testing and your knowledge of the market. If this level here, the daily range was only say 80 or 90 pips, this might be down as low as 20 for the target range. But how you use this range is once the EA has calculated where this line is in relation to the low of the day. So we're taking a sell trade, so it's going to look at because it's a sell, it's going to look at the low of the day, then it's going to look for how far the ADR is away and find a price. So the price here is, what is it, 1.3, can't read it very well, it's too small, 38603 I think it was. It's going to find that price. It's then going to take 40 pips off of that price. So it's going to take 40 pips off. If you look down, that's going to bring us down to around about there. So it's going to bring us around to this area here. And that is going to be the ADR take profit range. 40 pips from this line here. So this is where we are saying when price reaches that point, when it reaches the target range, take these actions. So let me go over that again. So we're using the set ADR take profit range. How we will set that point is it will look at the low of the day. This is for a sell. If it was looking, sorry, this is for a buy. If it was looking for a sell, it would measure it from the high of the day and measure 156 pips down. So we're looking for a buy, so measure it from the low of the day, which is 156.1 pips is here, that's that line. Then it would deduct whatever you put in here. In this case, I'll put 40 pips. So it would deduct 40 pips, and that would give us a target price. Now, when a live trade, as you'll see when you use DTFL Pro, when a trade is actually taken and there's a panel that opens up here, and one of the things you'll see here is the ADR target, and it gives the price where this this calculation, this 40 pips is. So it gives you the actual price that the target is. We don't know that in advance until the entry is made, but once the entry is made, the EA makes all the calculations, and you will see it displayed here what the target price is. And as price moves up, when it hits that target price, it will then take the actions you've told it to here. So that's what's happened here. The price will move off, and it will come out and it will hit the target range, which is in this area here. When it hits it, it will then take a certain amount of profit. And the profit it will take is what you put. If you put 100% in here, if you put 100, then it will close the whole position as soon as that level is reached. If you put 50%, then 50% of the position will be closed when it hits that level, and 50% will start to trail in the same way that I explained for the standard ADR take profit. Sorry, for the standard take profit, in the same way I explained it. So in this situation here, so you know the target range is going to be about here somewhere. The actual price will be recorded here, so and there's a countdown to how close it is until you hit it. That's all displayed up here when the panel opens, when the trade is actually live. As it comes up, it will hit that level. It will immediately look here, it will close half of the position. Half of the position will then start to trail current price, and it will trail immediately. What it will do is move the stop loss to this distance away from current price. So let's assume, let's use that one. let's say that distance there was 40 pips from there. It's more. Oh, it's not far. Pretty good guess, isn't it? But it's come up. It's hit that level there. It's 40. It's hit the level that we've said before we've gone to work. We set this all up. At this stage, all we knew was the ADR, and we're saying, well, if a trade is taken any time, any buy trade is taken, then we know that when it gets to that level, an action is going to be taken. So it's moved up, it's hit that level. It's telling you're telling the air to shut 50% of the position. 50% will then go on and trail. And you're telling it here where to move the stop. The initial stop loss will move 5 pips away from that position. So it will only move 5 pips away. It will start to trail from here. And as price goes up, for every 0.5 pips, each step it does to move to the north, moves further into the profit. Every 0.5 pips it moves into profit. Then this stop loss, which is initially at 5 pips away, will move at 0.5 increments following it. And it will continue to follow it until price retraces and hits it. As you can see here, it's probably going to end up in a very similar position to where the other half of the position was closed. But let's say this continues to go up and up and up. We could be trailing and trailing it. We could be trailing it for days in theory, unlike TAM, because it does retrace every so often. But so what would happen again when this level is hit? That is calculated by the DTF ADR is taken from the low to this level. Then the range you've put in here is deducted. That gives you a target for the target price. When that target price is hit, the EA will carry out the actions you've taken here. 50% of the position will be closed. The stop loss will move to 5 pips away from the current price, and it will start to trail at 0.5 increments. So that is how the ADR works. Now there could be a situation. I've explained how standard take profit works. I've also explained how the ADR take profit works. There could be a situation, dependent on when this calculation is made, and the calculation of where this point is. It could be that the distance from where your entry is taken to where this line is. Let's say the entry was taken here. It wouldn't be, but we don't know what the price action is. Let's say the entry was taken here, and when the entry was taken, the target is only 17 pips away. So let's say there's an entry taken there. Again, it's a buy. When you apply the target range, deduct it from from this point here, we find it's only 17 pips away. What this input does here, it allows you to set a minimum amount for your ADR take profit target to be. In this case, it would only have been about 17.5 pips, and that is less than the minimum you've stated. So in those circumstances, what would happen is that the ADR take profit target would be ignored, and the standard take profit would be applied instead, even if you haven't selected it. Even if you're only using the ADR take profit, even if you're only using this one, if the potential, let's move that back. If the potential profit from there to there, from the entry to this target point that's been calculated, if that distance there is less than what's in here, then the ADR will not be used and it will revert to whatever you've put here. So it's very important that you enter standard take profit target, even if you don't intend to use it. So in this case, what happened, if there was an entry there, nothing would happen when the price hit this level. It would actually set a take profit of 40, which is around here, somewhere there, about there. So it would be looking for a profit level about here. So that's what this input there does. So hopefully that's explained both of these. You can use them both together. You can use them independently. There's one more thing to explain, is that if you do choose both of them, then you would think there may be some conflict because they're both trying to take profits at different times. So the rules, the EA follow, if you've selected both of them, is that in relation to closes or partial closes, the percentage closes here, the percentage closes here, as long as there's a figure put in there, if there is 0, then there's no partial close. But if a close of any type is taken, any percentage close is taken, the rule that the EA works to is whichever of the standard take profit or the ADR take profit, whichever of those happens first, then that partial close or full close is applied and the other is then ignored. So in the situation here where you had a let's say in this one, so we've got it as you've sorted it here. So you've got an entry here, price is moving up, and what would happen is as soon as it reached 40 pips of profit, which is about here, when it reached this level, half of the position would be closed. If it then went on and hit this level here, this would now be ignored. You would not get another 50% close because there's already been a partial close. So that means that the standard take profit has been applied, the partial close here, so the other one is ignored. If this one was applied first, then this one would be ignored. That's in relation to partial closes. So which the rule is, whichever partial close is applied first, the other is ignored. Now the other thing that these two things control is the trailing stop. So if there is a trailing stop, at any time there's a trailing stop, whether it is initially set off by the standard take profit or the ADR take profit, in this situation, if this position was hit here after 40 pips, half of the position will be closed and then half the position start to trail. Now in trails, both the ADR and the take profit can trail. They've both got amounts here that you can trail. The rule that is used is that the EA will continually look at both the trail distance here and the step value here, and the trail distance here and the step value here, and whichever of those two figures, whichever of those combination of figures allows the stop loss to be closer to current price. So when we're looking for a buy, whichever is going to move the stop loss higher and gain more profit, it will default to that. So I'll tell you that again. So in relation to trails, the standard take profit, which here is initially at a distance of 10 pips and will move at 5 pip increments, and the ADR trail is at initially at 5 pips from current price and will trail at step at 0.5 pips. When what would happen is, as the price came up from this entry here, when it hits 40 pips of profit, because this one would be hit before this level, it would close 50% of the position. This would now be ignored, the close here. However, it would look at both the trail and the steps from both of them, and it's saying here to initially trail at 10 pips. So if it has hit the 40 pip level, it would trail at 30 pips, wouldn't it? 10 pips behind. But this one is saying trail at 5 pips, which is closer, it's more profit. So it would actually, the EA would automatically work that out, and instead of putting it, even though it's been controlled initially by hitting here, it wouldn't move it to 10 pips from this level, it would use this value here and move it 5 pips. So you'd end up 5 pips away from the 40 pip level, which is at 35 pips of profit, and it would start to trail at that point there, and it would start to move at 0.5 increments, because that is going to move it up quicker than the 5 pip increment. In fact, depending on what you've put here, it could be swapping backwards and forwards between controlled here to controlled here, whichever is moving it further north, whichever is getting you closer to current price. So that's how these two things interact. Quite complicated that. I'm just going to summarize it as quickly as I can. You've got, first of all, you can use either or, the standard take profit on its own, or you can use it in combination with the ADR take profit. You always need to put in a standard take profit, even if you're not intending to use it, because it may be used by the ADR take profit in certain circumstances. So it's very important to fill something in there. So the standard take profit, what it's saying is when a profit level has been reached, in this case 40 pips, close this percentage of the position, in this case 50%. If you put 100 in here, it will close 100% of the position and there will be no trail. If you put 50 in here, it will close 50% of the position and the stop loss will immediately move from 10 pips away from current price, which is at the 30 pip profit level, and start to trail every 5 pips. Every 5 pips that the price moves north, then the trail will move and follow it. So every 5 pips of incremental steps, as it goes to 45, then the trail will move to 35. When it goes to 50, it'll move to 40. When it moves to 55, it'll move to 45, and it'll keep following until eventually it's hit. That's the standard take profit. The ADR take profit, how that is calculated, is when the entry is taken. So let's assume the entry was here, and if it's a buy, it will look at the low. If it was a sell, it would look at the high, and in this case it's a buy, so it calculates the distance from the low of the day. It applies the DTFL ADR, which is 156.1. It applies it, which is this line here. It then takes off the ADR target range which you've applied, which is, sorry, let's move that back, which you've applied, which is 40 pips from there, and this gives you a target point, which all this information is displayed up here in the panel when the trade goes live. When the actual trade is placed, it's all automatically calculated, even counts down to how far you are away from that target range, so you can see how close you are to hitting it. When it does hit there, it does exactly the same as it did in the standard profit. It will close a certain percentage. That could be 50. If it was 100, then it would close it, the whole position completely. Obviously there'd be no trail there because there'd be nothing left to trail. In this situation, it would close when it hits there. 50% of the position would be closed. Then the stop loss would be immediately moved from 5 pips away from current price, and it would start to trail every 0.5 increment that it moves north. It will follow it at 0.5. So when it was at when it moves 0.5 up from this level, the stop loss will lose 0.5, and it continues to follow it until it's hit. Then the rest of the position will be closed, the remaining 50%. The only other thing apart from that, if both of them are selected, the rule is whichever target is hit first, whether it be the ADR target here, or in this case 40 level. In the circumstances here, obviously it'd be the 40 pips which would be hit first. So this would then control the partial close. Once one of the, either this one or this one has made a partial close, the other one will be ignored. Once that has happened, that will be ignored. And I have to stop now because I've been interrupted. So I'll just carry on and then have to cut this bit out. So when, let's just reiterate how the only other circumstances we need to worry about is if both are selected, what are the EA's rules? The rules are for partial close, whichever is hit first, so whichever is hit first, then that will apply. It applies a partial close and the other one will be ignored. A partial close also includes a complete close of 100%. So when I'm talking about a partial close, it could actually be 100%. So in this circumstances, where we've got a range which is calculated to be there, and we've got the take profit range of standard take profit range of 40, the 40 is obviously going to be hit first, so this would apply. This would then be ignored. If we change this to, let's say the target profit was 100 pips, and 100 pips from there is, we'll have to make it actually, say the target profit was, say you said it was 130, so you put 130 in there. That was the target profit you were looking for the day. So what it would do, obviously 130 from the entry price is up to about here, then that would mean that this one would be the first one here. The ADR take profit would be the first one here. And that would mean that 50% of the, let's say that changed out, let's change that to 75%. So on this occasion, what would happen is this one would be hit first and 75% of the position would be closed. Then when it went on and once it hit this level here, the 130 level, this would be ignored. You wouldn't get another 50% of the remaining 25% close. It will be ignored because already there's been a partial close applied. So whichever partial close, whether it be this one or that one, whichever one applied first, the other one is then ignored. In relation to trails, once a trail is applied by either, the EAL monitors both of them all the time live, and it will always pull the stop loss closer to current price, so giving you the most amount of profit possible. So it will apply both of them. So if these are completely different, you could have this one at this one might be, let's show you something a bit different. You could have it set like this, 0.5. So you could have it, a trail has started, it looks here and it said this one initially trail at a distance of 5 and have steps of 10 pips. This initially trails at 10 and has steps of 0.5 pips. So initially it will move to 5 pips away from current price because that pulls it closer. However, it when being controlled here will not move until price has moved another 10 pips north. However, with this one, when it gets to 11 pips away or 10.5 pips away, this one will apply, won't it? And it will move at a 0.5 increments. So what it is, we're swapping backwards and forwards between the two, pulling it north close to current price. There may be some questions on this. This is the hardest thing that I've had to explain on these videos. But obviously, if you listen to them carefully, I will do some follow-up questions on that with this, I'm sure. But hopefully this will give you a good grounding, especially when you read the manual, watch this a couple of times. Hopefully my blabbering voice hasn't been too monotonous and you will get it. They are very powerful features. They can be used very, very cleverly if you think in advance how you want to use them. So that completes the explanation of these standard and ADR take profit screens. The next one I'll be dealing with is timed exits.